artificial intelligence is something that everybody's, spending a lot of time trying to understand. And, we have experts in all the time and try to understand its implications for the economy. And, there's just a range of views. We don't really know. The question will be whether it is employment augmenting, like so many technologies, so that it's not, or is it employment replacing? And over time, it may be first one and then the other. But that's the question. So if what new technology does is it raises productivity. In the short run, it can sometimes put people out of work. And that's been true of advancing technology for forever. So what is AI going to be? And I think we have a very healthy discussion going on out there. We actually had a meeting at the Board of Governors in Washington with 6 or 8 of the, very well-known. These were academic economists and experts, and they were split. There were people there who were on the optimistic end side of things, saying, we basically have a labor shortage, and the economy wants to grow faster, and AI is going to help us do that, and it's going to lift all boats. And then there are other people who see that it can replace so many tasks that are actually not just that are pretty complicated tasks that you need some education to carry out, but AI can actually do them maybe even better than people. I don't think we know. I think that there's also another side to it, which is the potential systemic ramifications of having AI and the financial markets interacting. And so there's a lot of thinking going on about this. We're in the early stages and a lot of uncertainty. So I'd say it's going to be a while before we really understand how it needs to be regulated and how do we capture the obvious potential productivity increasing benefits of it without experiencing macroeconomic or financial stability costs.
Classically trained economist from Georgia Tech, instead of being in the front. But I'm wondering, is there a target on labor force participation? Because unemployment is low, but it feels like those labor shortages you talked about are remaining, and it's been much larger in how it impacts our experiences and also people's household income than what's reported.
Great question. Let me open that up a little bit for people. So you have the general public, right? And a certain number of those people are either working or looking for work, actively looking for work, as in they've looked within the last month. And those people constitute the labor force. They are participating in the labor force, either by being employed or by actively looking for jobs. But there are many, many people who are not in the labor force. And if you're not in the labor force, then you're not counted as unemployed. So you have to watch. You have to look at all of those things to understand how the labor market's going. During the pandemic, many people dropped out of the labor force, and so I thought that when the vaccines came out and the economy reopened, that people would come right back, but they didn't. You ask, is there a number that we target? The answer is not really. We have an assessment of, if you look at what drives, the thing that is happening with labor force participation is, as the population ages, as people get into their older years, they become less likely to be in the labor force, and so there's a downward trend in labor force of about 0.25% a year. But that doesn't mean in any given year that labor force participation can't go up. There's nothing like a really hot labor market like the one we've had to bring people back in, and it did in 2023. Or people stopped dropping out. It's the same thing. The net was that labor force participation increased. Immigration also increased, that's a whole other thing. That's just an increase in the population. And immigrants who come in, they tend to go into the labor force in about the same proportion, roughly, as people who are already here. So we wouldn't have a particular number. We're not quite back to the level of labor force participation that we were at before the pandemic. But that was before the pandemic. We had a 10-year, 8-month expansion, and participation tends to creep up as a lagging indicator in a strong labor market. So we're at a pretty high level of participation, as high or higher than the models would have predicted. But we'd love to see it go up further. We actually have lower labor force participation rates than many other advanced economies, which is not our self-image as a country, and not where we want to be. There's just a lot to do in the labor field. So another thing, if you're looking for an area of economics to study or a field to work in, the whole area of labor market economics and how do we support a better workforce, invest in a great workforce is a very important area to think about studying and working in.
And how does this impact economic indicators and the Fed's monetary policy consideration?
Consumer spending. Yeah. So consumer has been very strong, and it's been surprisingly strong. There was what were called excess savings. So people couldn't spend money on trips and restaurants and bars and things like that because it was COVID. Everybody was staying home, so they saved money, and also the government gave checks to people to sort of make them whole and replace their lost income and that kind of thing. So particularly people who were income constrained had much larger piles of savings than they had before the pandemic. And there was always this thought that would get spent down. And so this very strong spending we had in 21 and 22 would ultimately go away. What's been amazing is how strong consumer spending has continued to be. And it may well be, you see credit card borrowing going up. You see defaults going up now. So we may be actually getting to the end of that. So to your point about monetary policy, we're, of course, very, very carefully watching as the economy appears to be slowing this quarter. We think it's quite early in the quarter to be able to say that, but we think the third quarter was very, very strong. GDP, we think it's slowing now based on the limited data that we have, and all forecasters basically are saying that it will be. We're looking to see how much slowing there is. 70% of the U.S. economy roughly is consumer spending, and so that's going to be the big thing. As long as unemployment remains low and employment remains high and wages are moving up above inflation, though, there's no reason why spending wouldn't continue to hold in there. So if you look at the history of campaigns to bring down high inflation, what you will see is in most instances, not all, but in most instances, that has wound up. We know that higher interest rates, of course, will slow the economy, and that's the tool we have to bring down inflation. In many instances, that has resulted in significant job loss necessary to restore price stability. We haven't seen that here, and we've always felt, my colleagues and I have always felt that we had a chance, that there's a path to getting inflation back down to 2% without that kind of large job loss. And I still believe that. I've always believed that, and we're on that path. But some softening in the economy has happened. You've seen growth slowing back to a more sustainable level, and we hope we can stay on that path. We have to restore price stability because price stability is really the bedrock of the economy. And everyone, once prices are really stable, inflation's stable around 2%. People can stop thinking about inflation. They can focus on everything else. When inflation is volatile and high, not many are old enough to remember what that was like, but it's really, really bad for businesses and households trying to plan. In terms of other tools, I wish we had them, but the fiscal authorities have their tools. We have our tools, and our tools are interest rates and our balance sheet, which affects interest rates as well.
Welcome to the Crypto Teacher. And I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And don't forget to join the Patrons. If you're not a part of the Patrons, make sure you're hitting the Cash App. And we have Jerome Powell giving us some truth. Artificial intelligence can replace humans in the workforce. Guys, we know he's already said we're not going back to that old economy. And he's at Spelman, and that was John D. Rockefeller's wife, middle name. But the college was named Atlanta Baptist Female Seminary and then changed by the Rockefellers in 1884. And we know the educational system in America was shaped by Rockefeller. Remember, they wanted workers, not thinkers. And then if you are a thinker, they're going to make sure they get their hands on you when you're young. Remember, they take the greatest minds and use them for evil. Now, we had Jerome Powell, surprisingly, also told the truth about the labor force. If you're not getting unemployment insurance and you haven't received a job after a month, you're not counted. So guys, looks like I stated, unemployment is probably about 20 to 25%. And in the minority communities, it's probably 40%. And remember, the crypto teacher told you. And Jerome Powell stuck with the consumer is strong, but we know they're racking up the credit cards. Only thing you have to do is go to the Fed website and see. Savings accounts are getting low, and inflation is part of that reason. And who caused all this inflation? That's right, your Congress and the Fed. And then what are they doing? Raising rates. That's the only thing they can do to fight the inflation that they cause. And the key to making it in this world, I don't care who you are, it's all about learning how the world really works. Because once you understand how the world works, you're going to find out that it's all planned out. And remember, the crypto teacher told you. Because he knows when it comes to the NWO, it's all planned out. You have a wonderful day.
I'm a senior psychology major from Hampton, Virginia. And I know that you spoke to a little bit what the Fed can and cannot do in terms of the racial wealth inequality in America. Do you have any advice for what we as young Black college students can do to help combat that racial wealth inequality?
You know, I will say this. The thing that has always moved me the most in that area is education. So I was the founding chair of an inner city charity in Washington, D.C. I was also active in a similar charity in New York City to help inner city kids get an education. And you find their parents, or often their single parent, are desperate to get them the education they want and keep them away from trouble. And so there's so much to do there. And, you know, every kid who gets through 8th, 9th, 10th, 12th grade, you know, and is doing well at it, it's just a person who now has a chance at a middle class life. So I think that, to me, that's the thing. You know, our education, it's really hard and really important. But education is the road for people, we have one form of inequality is mobility, and there's a lot of work by an economist named Raj Chetty, who I know my colleagues know, who really measures mobility. And U.S. actually has lower income mobility than other major democracies, and it correlates heavily with race. So I think there's so much to do there. I mean, my wife and I spent a lot of time and no small amount of money supporting this cause over 25 years, but I think that's a great cause.
Practices. What are some of the lessons learned from what was an extraordinary time?
It's tempted to start by saying that, you know, we'll need some more years of perspective to really look back and have a better answer. But I'll give you a sort of in the middle of things, tentative answer. So, I mean, I'd start with the fact that the U.S. economy has really been the star performer in the world since COVID. And so, you know, we've had higher growth. We've had a stronger labor market. We actually have had inflation coming down now faster than most other economies. So basically, compared to other countries, we've done well. Looking back, the economy got stronger much faster, I think, than we expected and than most people expected. If you think about, you know, if you go back to the time of COVID when it was actually hitting in the first half of 2020, you're looking at a situation where the economy around the world is closing, where we don't have any idea how long it'll take to get vaccines, where we don't know how we will reopen the economy. If you can't get vaccines, we didn't know how lethal the disease was going to be. So there were real possibilities that you could be in a longer-term situation where you just couldn't get the economy back up to full speed. We just didn't know. And so Congress acted, I mean, with no dissents. Imagine that. No dissents passed the CARES Act, which literally put trillions of dollars of potential lending power in our hands. It was so big that we didn't have to use it. The financial markets were kind of closed, and they reopened without our having to use this authority. So we made very few loans in the end. It was amazing. But so if you look back on that, I mean, what you know now that you didn't know then was that the economy really did recover much more quickly and much more forcefully than we thought. And of course, you would have acted a little bit differently, knowing that. But overall, we'll have to judge this with some over time, looking back over time. Remember how extraordinarily unusual, unique the circumstances were. We hadn't had a pandemic in 100 years. No one knew what to do. At the very beginning, there was a question, well, why is the Fed even focusing on this? And then, if you remember, there was a very small stimulus bill that couldn't pass before then. And then 2 weeks later, the CARES Act is passing with all this. So it was a moment of great uncertainty and learning. Really surprised us and all other forecasters. It's so if you go back a year, not many people, and I'm not aware of any people who forecasted that we would have quite the level of strong growth that we have had in 2023, around 2.5%. A labor market that's still been creating millions of jobs, and yet inflation beginning in June coming down, very meaningfully. So coming down significantly. So, and those are all good things. All three of those things are good things. So we've been surprised on the upside this year. In 2022, when we were raising rates very rapidly, it didn't seem like we were getting any payback from that, but we really did get a lot of payback this year, and we also got the unwinding of those pandemic effects that I talked about. So that's people dropped out of the labor force, and they didn't come back in 22, and then they did come back in 23, and also immigration picked up. So all that's happening. So looking ahead, once again, we're still in a place where there is there isn't any experience with year 3 of the pandemic recovery, the last time we had a pandemic. It's just unique. But so if you just take on board what I said about where the economy is and where policy is at a restrictive level, meaning it's holding the economy back. Inflation is still running well above target, but it's moving in the right direction. So we think the right thing to be doing now is to be moving carefully, thinking carefully about how things are going on, letting the data tell us what the story is. The data will tell us whether we've done enough, whether we need to do more, and that's what we're doing. We're moving. I would characterize it as moving carefully, going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth instead of trust, and we will save over $7 trillion a year. 6 to 8% of global GDP is wasted by the friction of the trust industry that's necessary when you have dual entry accounting. With triple entry accounting, which is what a blockchain is, we get rid of all of that friction. It's a beautiful future.
Like what you see in China and their social credit scoring systems, right? If we get identity wrong, it could be a tool to enslave humanity. And if we get it right, it could be a tool to liberate humanity. And as an American, I'm obviously rooting for the one that's on the side of freedom.
Bitcoin is an international asset. And also, I do believe the role of crypto is, it's digitizing gold.
I actually believe this technology is going to be very important. Look at it. We have been part of a huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. We will, and if we can have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
Chinese bank ICBC has been hit by a ransomware attack, and the U.S. Treasury market, as a result of that, has been disrupted. This, according to the Financial Times. We're getting it more right now with Bloomberg's Shonali Bassick. Shonali, what do we know?
Listen, we have the Financial Times now reporting that ICBC, one of China's largest banks here, was hit with a ransomware attack. And remember, they're a very significant intermediary in the Treasury market. The SIFMA has told its members that this has been part of the reason here that the system is kind of clogged up, if you will, during that auction that we saw a little bit before. The attack had prevented ICBC, according to the Financial Times, from settling Treasury trades on behalf of other market participants. A large executive at a major bank also telling the paper that such a large party on the fixed income clearing corp creates major concerns, potentially impacting the liquidity of Treasury markets.
Now, it was not just a poor auction. It was absolutely lousy, and you know, when the dealers have to step in to save a Treasury auction, that's a rare occurrence. And
Cryptoteacher and the New World Order book, plus the 3 kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get on stocks, the Seaver, the biotech stocks. And while everybody's at home wishing, they were still getting that free money. What are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know, I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID-33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.